Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps the channel out. So before we look at a single balance sheet today, I really want to just, set the table for this.
Oh, absolutely. There is a lot to unpack.
Yeah, because we are looking at a massive stack of research today. We're talking their 2025 earnings report, the latest SEC filings, recent mining industry forecasts, because we need to figure out the reality behind what is honestly a staggering market move.
Staggering is probably an understatement here.
Right. I mean, we are looking at a stock that just went on a massive 340% rally.
Yeah.
Like, just to put that in perspective for everyone listening, that's a climb from $4.80 back in February 2025 all the way to $21.34 by February 2026.
It is a remarkable trajectory. I mean, truly. But as wealth builders, the focus always has to shift from looking in the rearview mirror to, well, analyzing the road ahead.
Exactly. Past performances and future results and all that.
Right. So the primary goal for you listening today is to really understand if this momentum is actually sustainable or if it's just, a flash in the pan, a meme stock kind of run.
Which happens a lot in mining.
It does. It absolutely does. So we are dissecting how this specific company is transitioning from what was basically a development phase narrative into what looks like a multi-year cash-generating champion.
Okay, to really wrap your head around their fundamental market position today, I want you, the listener, to imagine something for a second. Let's say you own a toll booth.
Okay.
But not just, any random toll booth.
Yeah.
You own the only toll booth on a major interstate highway.
I like where this is going.
Right. And now, imagine the government just passed this strict mandate declaring that absolutely everyone driving cross-country must use your specific highway.
No detours.
Exactly. No detours allowed. You have to pay the toll. That is essentially the foundational premise of Energy Fuels' position in the market right now.
It's a great analogy.
Thanks. But, to understand how they actually built that toll booth and why the stock rallied so violently over the last year, we first have to look at a number that honestly seems completely contradictory.
Ah, right. You are referring to the net loss they reported for 2025.
Yes, the net loss. I mean, they reported a net loss of $86.1 million for the full year of 2025.
Which is roughly 38 cents per share.
Right. And what's wild is that this is actually a huge increase from the $47.8 million loss they reported the year before. So on paper, if you're just skimming the headlines, you look at a doubling of their net loss and you think,
But how on earth does a stock rally 340% when the company is losing more money than ever?
exactly. It makes zero sense on the surface.
And this is exactly why, it's a textbook example of why headline numbers can be dangerously misleading if you don't actually understand the mechanics underneath them.
So what's the actual story there?
Well, that $86 million loss, it's actually masking this explosive margin inflection point. When you dig into the filings and break down what actually drove that loss, you see it was primarily non-recurring items.
Like one-time fees.
Yeah, exactly. You have about $6.9 million in one-time exploration charges, plus some really heavy integration costs from when they acquired base resources. And on top of that, a temporary dip in the average realized uranium spot prices during that specific period.
Okay, so it's essentially a massive cleanup and setup phase.
That's a perfect way to put it.
It kind of reminds me of a manufacturing plant. Like, imagine a factory taking a severe, temporarily financial hit because they purposefully shut down their main assembly line for 6 months.
Right, taking it offline entirely.
Yeah, and they do it to install a brand new fleet of state-of-the-art robotics. Yes, it completely ruins your current quarterly earnings, but those robots are going to ultimately triple your daily output and drastically slash your overhead,
Oh, absolutely. It's short-term pain for long-term market dominance. That analogy actually captures the mechanics perfectly. And, the robots in this specific scenario are the high-grade Pinyon Plain mine.
Pinyon Plain.
Yes. This asset is the absolute turning point for the company's entire financial profile. Because high-grade ore basically means you have to move and process significantly less physical dirt to extract the exact same pound of uranium.
Oh, I see. So your heavy machinery isn't running as long, you're using less fuel.
Less processing time, fewer chemicals. Your overhead just plummets. And now that the ores from Pinyon Plain are actively being extracted and fed into their mill, their entire cost structure has been completely revolutionized.
All right, let's put some hard numbers to that revolution then, because the math is really where this wealth-building thesis crystallizes.
Okay, so the total weighted average uranium costs for the company are projected to drop to between $23 and $30 per pound in 2026.
Wow. $23 to $30.
Right. And that aggressive drop in extraction and processing costs ranks them among the lowest cost producers anywhere on the globe.
That's huge.
It is. Now, to really understand the margin here, compare that $23 to $30 production cost to the current uranium spot price.
Which is what right now?
It's sitting comfortably around $101 per pound.
Wait, really? $101?
Yeah.
So they are pulling the material out of the ground, processing it for roughly $30 at the absolute high end, and then turning around and selling it for over 100.
Exactly.
That is, I mean, that's the potential operating margin of over 70% on their incremental production.
It's staggering.
Yeah. We usually only see those kinds of margins in like software as a service companies.
Yeah.
You do not see that in heavy industrial mining operations.
No, you really don't. And the critical factor here is that they aren't just maintaining their historical sales volume with those newly expanded margins.
Right, because of the new mine.
Exactly. The physical reality of the Pinyon Plain mine ramping up operations means their actual output is scaling dramatically. Their 2026 sales guidance reflects a massive, massive jump.
What were we talking?
They are going from selling 650,000 pounds in 2025 to a projected 1.5 to 2 million pounds in 2026.
Oh, wow. So they are physically tripling the amount of material they bring to market while simultaneously unlocking a 70% margin on every single pound.
That's the magic formula.
I mean, that completely contextualizes the stock rally. The market is clearly looking entirely past those 2025 integration costs and pricing in this massive wave of cash that's expected in 2026.
Precisely. The market is forward-looking.
Right. But, okay, that leads us directly into the next major pillar of this analysis. Because mining is notoriously capital intensive.
Oh, heavily.
Yeah, companies are constantly diluting their shareholders. Like they issue new stock just to fund expansions, and the existing shareholders get wiped out. So how is Energy Fuels funding its incredibly ambitious transition into rare earth minerals without watering down the value of the shares that you or I might hold?
That is the million-dollar question, or in this case, the $900 million question, because they have constructed what is essentially a fortress balance sheet.
A fortress balance sheet.
Yes. As of the end of 2025, they were sitting on $927.4 million in working capital.
Over $900 million.
Right. Now, working capital isn't just cash sitting in a checking account somewhere. That figure includes $64.7 million in pure cash and a massive $797.1 million in marketable securities.
Okay, let me jump in here. For our listeners who might not be deep into corporate treasury management, having almost $800 million in marketable securities is a uniquely powerful shield.
It really is.
Because we're talking about highly liquid investments, right? Things like government bonds or short-term corporate paper, stuff that earns a yield but can be liquidated and turned into usable cash almost instantly if the company suddenly needs to deploy capital.
Exactly. It provides immense operational flexibility. You aren't just sitting on dead cash, losing out to inflation.
Right.
And a massive portion of that liquidity stems from this highly strategic financial maneuver they executed back in October 2025. They completed a $700 million convertible senior notes offering.
That was led by Goldman Sachs, wasn't it?
Yes, led by Goldman Sachs.
Okay, wait. I need to push back on this Goldman Sachs deal for a second.
Sure.
If they already had so much cash flow coming online from the uranium and such a strong balance sheet overall, why take on debt at all?
Oh.
I mean, even if the interest rate is extremely low, and I believe it's, what, 0.75%?
Correct, 0.75.
Right. So why invite debt onto the books when you have cash? Is it just cheap leverage? What's the play?
It is cheap leverage, but it's also primarily about preserving the upside for shareholders. For those unfamiliar with the instrument, a convertible senior note is basically corporate debt that pays a really low interest rate, but it gives the lender the option to convert that debt into shares of the company's stock at a specific preset price sometime in the future.
Ah.
So the crucial detail here is the conversion price they actually negotiated. It was set at $30.70 per share.
Wait, $30.70, which was a 100% premium to where the stock was actually trading at the time of the offering, right?
Exactly, a 100% premium.
Okay, so let me make sure I'm synthesizing the institutional psychology here. If the smart, Money like massive institutions like Goldman Sachs agreed to a $30.70 conversion price, along with a capped call to prevent excess dilution. Aren't they essentially placing a $700 million bet that the stock price is going to blow past that number?
That is exactly how you should read it. Sophisticated lenders do not hand over $700 million at a microscopic 0.75% interest rate unless they have intense conviction in that equity upside.
Right. They don't care about the 0.75%.
No, they don't want the interest. They want the shares at $30 because they think it'll go much higher. And for the broader market, seeing that deal establishes a psychological floor and a very clear breakout target.
And what about that capped call? Can you explain what that actually does for the everyday shareholder listening right now?
Absolutely. The capped call is essentially an insurance policy the company buys to protect you, the existing retail shareholder. If the stock explodes to, say, $50 a share, normally those convertible note holders would convert their debt to equity and just severely dilute the overall stock pool.
Right. Suddenly there are way more shares out there.
Exactly. But the capped call mathematically limits that dilution. It shows that management is hyper-protective of their equity. They are raising massive capital, yes, but they are structuring it to ensure the current shareholders capture the upside.
Wow. And that fundamentally alters their historical cash flow narrative, doesn't it?
Yeah.
Because in the past, they ran negative free cash flow. They were just burning through capital to build up these upstream mining assets.
Yeah, they were in a building phase.
But now, with the uranium business printing money at a $30 cost and a $100 spot price, that segment alone generates enough free cash flow to completely self-fund their expansion into other critical minerals.
That is the pivotal shift right there. The uranium cash cow pays for the growth engines of tomorrow. It entirely removes the reliance on shareholder dilution going forward.
Okay, so the cash is there, the margins are there, and the volume is there. But in any serious wealth-building analysis, we have to look at the competitive moat. Right. What protects those 70% margins? If this is so lucrative, why can't a well-funded competitor just look at this blueprint and build their own version?
Because the barriers to entry are practically insurmountable at this point. They've created what is essentially a double-barreled moat. To understand the primary moat, you have to look at the processing bottleneck.
Okay.
Having a mine is one thing, right? Anyone can dig a hole.
Yeah.
But getting the raw ore refined into a usable product is where the real power lies.
Going back to our analogy from earlier, it's the toll booth.
It is the toll booth. And their primary toll booth is the White Mesa Mill. It is the absolute crown jewel of their portfolio.
Why is it so special?
Because it is the only fully licensed and operating conventional uranium processing facility in the entire United States.
The only one.
The only one. And conventional processing means they have the massive infrastructure required to crush the ore, leach it with chemicals, and extract the concentrated uranium at a true industrial scale.
You know, to put that regulatory moat into perspective for you listening, trying to build a new conventional uranium mill today would be like trying to get an environmental permit to build a nuclear reactor in your own backyard.
It's near impossible.
The environmental reviews, the state and federal regulatory labyrinths, the community pushback. I mean, it would take well over a decade, assuming it didn't get blocked entirely, and it would cost an absolute fortune.
Exactly. So Energy Fuels effectively holds a geographic and regulatory monopoly, which is the ultimate competitive advantage. But they aren't stopping there. They are leveraging that primary moat to build a second barrel, vertical integration in rare earths.
Okay, I have to express some genuine concern here.
Uh-oh, let's hear it.
Well, trying to maintain a monopoly in domestic uranium processing is hard enough. Trying to simultaneously build a vertical integration moat in rare earths feels like they might be biting off way more than they can chew.
I see where you're coming from.
I mean, history is just littered with mining companies that tried to aggressively diversify and ended up stumbling into bankruptcy. Is this transition actually viable?
It's a highly complex transition, I'll grant you that, but the underlying synergies make it incredibly resilient. They aren't just starting from scratch here.
Okay.
They are securing low-cost monazite feed, which is the raw dirt containing rare earths, from their Vara Mada project.
Right, and the economics on that are super compelling. Because the data shows an all-in cost of $29.39 per kilogram of NdPr equivalent.
Right.
And just for clarity, NdPr stands for neodymium and praseodymium, which are the essential base metals required to manufacture the permanent magnets used in, everything from electric vehicles to wind turbines.
Precisely. They're critical. But pulling monazite out of the ground and separating the NdPr is only the first step.
What's the next step?
Well, to actually monetize it at a premium, you have to refine it into highly specialized metals and alloys. And for decades, Western companies could pull rare earth ore out of the ground, but they almost always had to ship it overseas, specifically to China, to be separated and turned into usable metal alloys.
Because the West completely hollowed out its midstream refining capacity.
Exactly. We just stopped doing it.
So how does Energy Fuels solve that midstream bottleneck?
That is exactly why they acquired Australian Strategic Materials.
Okay.
By combining the low-cost raw feed from Varamata, the separation capabilities of the White Mesa Mill, and the downstream alloying capabilities of the Australian acquisition, they are constructing a fully Western, end-to-end mine-to-metal supply chain.
Oh, wow.
Yeah. Competitors can't replicate this because they lack the midstream processing permits that Energy Fuels already possesses. They're closing the loop entirely within Allied borders.
So we have the structural setup. It's solid. Let's talk about the timeline. Because a great moat and a fortress balance sheet only move the needle if you have clear catalysts and the right leadership to actually execute it.
Right, execution is everything.
And the catalyst calendar kicks off heavily with a major leadership transition. On April 15, 2026, Ross Papu officially takes over as CEO.
He does.
Now, typically, leadership changes spook the market, right? Investors get nervous when the captain leaves the ship. So why does the quantitative sentiment scoring specifically rate this appointment as a bullish signal for institutional flow?
It really comes down to the life cycle of the company. The skills required to lead a company through its development phase, which involves, raising capital, lobbying for permits, surviving lean years, are vastly different from the skills required during the operational execution phase.
Makes sense.
And Ross Papu is widely recognized as the architect behind their strategic investments and acquisitions. His taking the helm broadcasts a really clear message to institutional investors. The messy building phase is complete, and the era of operational optimization has begun.
So it attracts a larger class of institutional capital that demands operational precision.
Exactly.
Going back to our analogy, he's the executive who knows how to run the factory at maximum efficiency now that the state-of-the-art robots are finally installed.
That is exactly right.
That makes strategic sense. So following that transition, when do we actually see the hard proof that these pinion plane ores are delivering that 70% margin we talked about?
Roughly around May or June, we will see the Q1 2026 earnings report. This is what we call the show me catalyst.
The show me catalyst.
Yeah, because the market expects this report to formally reveal the reality of that massive margin expansion. We need to see the hard math proving that those $10 to $14 per pound mined ores from Pinyon Plain are successfully being sold into that high-priced spot market.
Right. And when the market actually sees those 70% margins printed in black and white on an SEC filing, it's going to fundamentally change the valuation models.
Without a doubt.
And then following that, on June 30, 2026, we have the target date for closing the Australian Strategic Materials acquisition, which formally brings that downstream metals capability under the Energy Fuels umbrella.
Yeah, that's a huge milestone. But beyond the internal calendar, there are massive speculative macro catalysts in play here as well.
Like what?
We are looking at potential Department of Energy or Department of Defense grants, specifically tied to the White House Space Nuclear Power Initiative, alongside broader federal mandates for critical minerals onshoring.
Okay, let's pause and talk about that Space Nuclear Power Initiative, because that honestly sounds like science fiction. But it's a real federal budget item, right?
It is very real. The government is actively funding the development of nuclear thermal propulsion systems for deep space missions, and also surface power reactors for lunar bases.
Lunar bases.
Yeah. And those highly specialized reactors require advanced uranium fuels that just cannot be processed in standard overseas facilities due to security clearances.
National security.
Right. So as the sole domestic conventional mill, Energy Fuels is structurally positioned right at the front of the line for the federal grants required to build out that highly classified supply chain.
Okay, the macro policy tailwinds are undeniably strong here. But, to ensure we are providing objective, robust analysis for everyone, we have to stress test this thesis.
Absolutely. We have to look at the downside.
Right. We need to subject this bullish outlook to the harshest bear arguments currently circulating in the market. So let's look at the first major bear case: execution and timing risk.
Okay.
Critics argue that this entire rare earth roadmap is priced for perfection. They point out that actual meaningful profits from separated rare earth products probably won't materialize until 2027 or 2028.
Which is fair.
And furthermore, the White Mesa Mill currently cannot physically process monazite for rare earths and uranium simultaneously in the same circuit. So the bears argue the company is trying to serve two masters with limited infrastructure and will inevitably stumble. Are we sure they aren't taking their eye off the ball?
It is a valid logistical bottleneck to point out, but the bear argument entirely ignores the overwhelming strength of their cash flow dynamics.
How so?
The sheer volume of cash being generated by the uranium segment completely de-risks the capital-intensive construction required for the rare earth expansion.
So they don't need the rare earths to be instantly profitable because the uranium's essentially paying all the bills anyway.
Correct. The uranium cash pays for the construction of a dedicated Phase 2 rare earth circuit.
Oh, a separate circuit entirely.
Yes, it does not matter that they cannot process both simultaneously in the current legacy circuit because the uranium profits are funding an entirely separate, purpose-built facility. The cash cow is comfortably carrying the future growth engine.
Okay, that makes sense. Let's tackle bear case number 2, which focuses on macroeconomic supply. The threat of a rare earth glut depressing prices. We've seen stark warnings from analysts arguing that a massive boom in mining funding could cause a global oversupply of rare earths, just crushing profit margins across the board.
Right, and this is where understanding the technical nuances of the commodity market is really, really vital, because rare earths is an incredibly broad term. And to assess the risk, you absolutely must differentiate between light rare earths and heavy rare earths.
They aren't the same market.
Not at all. The oversupply fears are almost exclusively tied to the light category because those are far easier to mine.
Okay, let me try an analogy here to cut through the jargon for our listeners.
Go for it.
Think of light rare earth, things like NdPr as table salt.
Okay, table salt.
It is universally useful. Everyone needs it to manufacture basic electronics, but it is relatively plentiful and cheap to produce. If a dozen new mines open up globally, the market gets flooded with table salt and the price crashes. That is the glut the bears are terrified of.
Right.
But heavy rare earths, specific elements like dysprosium and terbium, those are like saffron. They are intensely rare, incredibly difficult to extract, and command a massive, massive premium. Does that track?
That is a brilliant way to conceptualize it, yes. The glut risk definitely applies to the table salt. But Energy Fuel's strategic value and their primary focus for the Department of Defense lies in the heavy rare earths. The saffron.
The saffron.
Right. Those heavy elements are absolutely non-negotiable requirements for defense applications, missile guidance systems, and high-performance electric vehicle magnets.
And right now, China heavily restricts the export of those specific heavy elements.
Which is the entire core of the bull thesis. The U.S. government has implemented strict domestic sourcing mandates because the military simply cannot rely on heavily restricted foreign exports to build their fighter jets.
Obviously not.
Right, so this government mandate provides a rigid demand floor that completely shields Energy Fuels from the broader global commodity gluts affecting the lighter elements. They are producing the exact scarce materials the government legally requires to be sourced domestically.
Wow. Okay, so bring this all together into a final investment thesis.
Yeah.
Based on the fundamentals, the massive margin expansion, and the double-barreled moat, the quantitative score sits at a very bullish 8 out of 10.
An 8 out of 10, yeah.
But the target horizon is critical for anyone listening. This is not a quick flip or a day trade.
No, definitely not. This requires a multi-year hold strategy. We're looking at an 18 to 36-month horizon here.
To the construction.
Exactly. You need to allow sufficient time for the operational execution phase to mature. That means time for the Australian strategic materials integration to complete, time for that Phase 2 rare earth circuit to be physically constructed using the uranium cash flow, and time for their pilot successes in heavy rare earth to convert into binding long-term commercial offtake agreements.
Right, so the foundation is poured, the framing is up, and now the market just needs to let them finish building the house.
That's it, exactly.
Which brings me to a final provocative thought I really want to leave you, the listener, with today. Something to mull over on your own.
Let's hear it.
As the U.S. government continues this aggressive, unapologetic push for critical mineral independence and supply chain onshoring, consider what eventually happens to a company that owns the only infrastructure capable of fulfilling that national mandate.
It's a great question.
At a certain point, Does Energy Fuels' monopoly infrastructure make them so utterly essential to national security that they begin to operate and be valued by the broader market lists like a volatile, traditional mining stock and more like an indispensable, heavily backed public utility?
It's a fascinating paradigm shift. I mean, when a company's output becomes fundamentally vital to national defense and energy security, the traditional rules of cyclical valuation begin to change entirely.
Exactly. It brings us right back to the beginning. You aren't just investing in the asphalt of the highway. You're investing in the absolute certainty that everyone is legally required to pay the toll. Keep that framework in mind as you watch this space unfold.